What really works well is selecting a monthly benefit over a daily benefit. For example, $5,000 a month is $170 a day. If you pick a daily benefit, you would have up to $170 to spend, and if a nurse came in on a particular day and charged $200, you would then have a $30 out-of-pocket expense. A monthly benefit says it doesn't matter what they charge throughout the days and the weeks. It's at the end of the month. If your bills accumulate beyond $5,000, then those days after that to the end of the month are your out-of-pocket expense. It makes a big difference. The next thing to look for is, again, the monthly benefit times the term. If you have a 36-month plan at $5,000 a month, you will start with a $180,000 pool of money. If you have $5,000 a month times a 5-year plan or 60 months, it's a $300,000 pool of money. Of course, it's going to be a little bit more expensive, but that's what you have to budget. You have to sit down, with your finances and find where you're most comfortable. We want your premium to be palatable. The next thing is what's called a deductible. You're familiar with deductibles in insurance policies. We all are. Well, in long-term care, we count a deductible in days, not dollars. So you have a choice of 30 days, 60 days, or 90 days. Now, remember we talked about major medical and Medicare paying the first 90 or 100 days of skilled nursing care, respectively? Those days are really considered nursing home days. Those days will count towards your deductible. So if you select a 90-day deductible and you have services for 90 days before being sent home, you satisfied your deductible. Even though you billed major medical or you billed Medicare for it, we counted it towards your deductible days.
Okay, but that's only if you're qualifying as a skilled service for Medicare or for your major medical.
Now let's say that you only have 30 days of care in the facility and you have a 90-day deductible, Medicare paid for the first 30 and your Medicare supplement, co-sharing the cost, and now you're left with 60 days. There is a rider that we can add on, and there are some policies that make it automatic, that there is no deductible for home health care, first day coverage, and I am an advocate of that. If we spent the money on the premium, we get home, we're ready for nurses for their services. That 0 day for home health care is the prudent strategy, and those next 60 days of receiving home health care will finish satisfying the balance of the 90-day elimination period. So it's kind of, let's call it a 90-0. 90 for facility, 0 for home health care, but care in either setting will satisfy the 90 days.
Okay.
The next thing is the most important component of long-term care. Studying long-term care in the last 30 years, we've seen the cost of care averaging, depending on high inflation years, low inflation years, I would say that it averaged about 4.2%. That's based on the Consumer Price Index urban sector. So most companies have rounded up their inflation rider, which is very important to have an inflation rider that will grow at 5% compounded basis to keep your policy up to date with inflation.
Okay, you need to explain what it means. Give me an example.
Okay. If we start out at $5,000 a month, what will that be worth 15 years from now? And with inflation, it'll erode the $5,000. So by adding for an additional cost of 5% compound inflation rider, we guarantee that every year your policy will grow at 5% on a compounded basis.
You mean compounded, the monthly rate?
The monthly benefit of $5,000 a month will grow at 5%, and in the 5-year example, the $300,000 pool will grow at 5%. So you know the rule of 72. You take an interest rate and you figure out, you divide that into 72, and it'll tell you how many years it will take your money to double. The 5% compound will double your monthly benefit in 15 years. You'll now be able to get $10,000 a month out, and your pool of money will now be $600,000.
But now inflation riders are only riders, right? You can choose not to have the rider.
You can choose not to have the rider. It's highly recommended that if you cannot afford the rider, reduce your benefit. Have the inflation rider, because we have much younger people buying long-term care insurance now. Our average age is 57 years old. It's not just for people over the age of 65. With now a life expectancy to easily be able to live another 30 or 40 years, the $5,000 a month will not make it. You must have an inflation rider. I'm very adamant about it.
Now, I also want to, because you don't have to also have a 5% inflation rider. Don't some companies offer like a 3% inflation rider or a...
Yes, again, here's where the major carriers are a little different from one another. There's actually 5 types of inflation riders. One is 5% compound. One is 3% compound, which your money will double in 24 years. The other is compound CPI, which a couple of companies are doing.
What's that mean?
That means that whatever the consumer price index does 12 months prior to 3 months of your policy renewing each year, they're going to lock in that number and give you an inflation increase by what those 12 months did as an average. So it can fluctuate. There can be low interest years and there can be high interest years, but it will be pretty much right on target as to what the actual inflated cost is going to be. So if we do have high interest years in the future, which is possible, we've had them in the past, if interest goes up to 13%, you'll get a 13% credit on your policy.
Now, is that rider more expensive than, say, a 5%?
No, it's not, because the CPIU in the last 30 years averaged 4.2%. So that would be less than a 5% compound. So it's sort of right in between the two.
Okay.
The fourth one is called 5% simple. It will go up at 5%, but it will not compound. So 5% of your original amount, it will double in 20 years. The third one is guaranteed purchase option. Upside of guaranteed purchase option, you only pay base premium this year without the inflation rider. But every year that you buy 5% more benefit each year, guaranteed to purchase more benefit, your premium goes up based on your new age. So every year you're a year older, you're buying 5% at that age, and it gets very, very expensive in the future.
Tell me what the average premium would be for somebody, and I'm going to ask you at 3 different ages, 55, 65, and 75 or 70.
Okay.
But we have to put some not statistics, but choices to that. So if we say a 5-year with 5% inflation rider, compound inflation rider, and a $5,000 a month. I like all those fives, I guess.
Do.
$5,000 a month benefit with the 90-day elimination period. What would the average premium, either annual or monthly?
The plan design that we're talking about, $5,000 a month, 5-year plan with the 90-day elimination period with the compound inflation rider, is going to run a 55-year-old about $2,000 a year.
A year.
Now they're going to be able to take off the discounts and being married and preferred and so on and so forth. A 65-year-old, it's going to be about $2,500 a year, and a 70-year-old over $3,000 a year. On the rule of thumb with inflation riders is if you're under 65, it's always recommended to have compound. If you're over 65, the rule of thumb is to have simple. So simple inflation is going to be a lot less expensive than the compound.
Now I know that there's something called a partnership program, at least in Florida, and I think in several other states. Can you explain what that is and how it came into being?
Yes. About 20 years ago, the Robert Wood Johnson Foundation set up a partnership program with 4 states. It was kind of like a pilot program, about 20 years now. And what they did was they said, okay, if somebody buys long-term care insurance, can we disregard assets equal to what the long-term care policy paid out in their spend down for Medicaid? Now, one of them was dollar for dollar, and the other option was total. So that meant that dollar for dollar, if you had a long-term care insurance policy pay out $300,000 in benefits, for example, and now you exhausted your plan, you can apply for Medicaid and disregard any of your assets that are liquidatable up to $300,000.
Are the insurance companies required to give you some statement that you meet this plan?
Absolutely, absolutely. There's a cover page in your policy when it's issued that says your partnership meets your policy meets the partnership specifications, and you are eligible to use this as a partnership plan. In my years of long-term care, it took my 7th year to have my first claim. And from that point forward, I have never had a month, a week, or a day, or a year that I have not had a client on a long-term care claim. It really works.
Cool.
Thank you.
All right, well, thank you. Now you've heard about long-term care insurance and how to look at a policy and what you need to, decide when you get the policy. And you've heard the views of Jimmy Lesage about wellness and kind of a holistic approach to wellness and weight loss. And boy, I'll tell you, I think that's a great way to go. And that's certainly the concept that I'm subscribing to. Thanks for watching. Bye for now.